Oh my goodness. What a day, what a day, what a day. Just going to take a few moments real quick. Let a few of you guys go ahead and get logged in. It's been some day in my neck of the woods. I don't know how it is happening for you guys, but in my neck of the woods, it's been a crazy day. The weather is good. I just want to tell everybody, be careful out there. Be careful out there. Where I'm at, we experienced a power outage, and it's dangerous. We can smile about it now, but it was a little tumultuous. There was a car accident. Sesomeone ran into a transformer, and they're doing well now, but because of a sequence of events, it shut down the power where we're at, but now we're up and running again. And so I'm so happy to be able to make this live stream this evening. Thank you for all of you guys who are logging in right now. The first thing is, what's interesting is the fact that you all are coming to us and you're meeting with us. That is really awesome. I want to thank all of you who have been invited here, whether you got an email, whether you got a text message, you got, our weekly invite. Some of you got your invite from your employer, which I'm finding out that's really cool. Some of you guys are that are joining us, what is it? HR, your HR has you following up with us, and that's really exciting. And to those of you, and this shout out is close to my heart. We have recently spoke to 2 or 3 folks, and what's really cool is that your parents told you to come to us, right? And we spoke to 2 or 3 of you last week, where your children told you to come listen to us and come chime in. And I thought that was extremely, we're all honored, and we're, happy to welcome you, happy to have you a part of the Laster Financial Consultant family. So that is really, really cool. That's really exciting for us. On behalf of I and my entire team, we welcome you. You're in a safe place. You're in a loving place. So as we're talking this evening, if you have anything to contribute, if you have any questions, we want you to chime in. We want you to type in your questions inside the chat box. We're on The Laster Financial on Facebook, as well as All About Others on YouTube, as well as we're broadcasting live on LinkedIn. That's really exciting. That's another contribution to what we're all doing here. And tonight's topic is going to be about the life of a flower. The life of a flower. We're going to jump in to, essentially talking about, what does it mean to flow your money? What does it mean? When you start hearing us say flow, 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 what are we talking about? The other thing is, what we're going to talk about is, why do we flow? What's the whole purpose of it? Why does it make sense? Okay. The other thing is, when you're flowing, there's a contract. So we want to talk about what exactly is in the contract for you to flow. Okay. And also, we're going to talk about guarantees. A lot of people invest inside financial products, and in those financial products, they do not talk about guarantees. We're going to be talking about guarantees to this program and how to use it. What does it look like for you to just have those guarantees? Then we're going to finish up by talking about, tax ramifications, taxes and all that good stuff. And then lastly, we want to make sure that we have that conversation is how to begin flowing. What does it take to actually to begin flowing? All right. Hope you got all that. And as I always say, we welcome all of you. Definitely, check out the playback. Oh, by the way, we welcome all of you who are watching the playback. We know some of you guys are probably still on your commute home. Maybe it's dinner time. Maybe you're just a late nighter. We don't know. So welcome to this conversation this evening. And let's just go ahead and get at it. All right, here we go. So what is a flow? What is a flow? Okay. A flow has three simple steps that's involved in it. But when we get down to the basic components of what is a flow, we have to actually just talk about the history of the flow, and then we make it to the flow and you understand what a flow is, right? So the history of the flow is, based upon, my experience, going on 16 years inside the financial services industry. I have had the privilege, the honor, and the burden of working with many affluent and high net worth individuals. And I was able to just step in, support them in the capacity in which I was supporting them, and do all of those items. But as I was doing that, I was also able to learn, what is it that they're doing that average folks don't do? That average folks are not doing what's going on here. Okay. Now, you take that into consideration and then add in that, what if you're one of those people, and maybe you can resound with me, on this. I wasn't one of those folks that grew up, how do they say it? With a silver spoon in your mouth, right? Truth be told, I grew up grinding, doing what I had to do, right? Working real hard. And like many of you, maybe you had a time inside your life where you had to hold down 2 or 3 jobs. My whole point of what I'm saying is that there was very little guidance. Maybe like you kind of had to figure it all out. Like, where did it go? Where did it come from? So to compare what these high net worth individuals, these very affluent folks were doing, I had to have something to compare it with. And one of the only thing that I had to compare it with is, how does a bank operate? Okay, and I want you to think about it, right? Because many folks are treating their home like a home. How do I say this? I'm sorry. Many folks are treating their business finances very similar to how they treat their personal finances. They're treating their business finances just how they treat their personal finances. And if you know anything about accounting, that's the one thing that you kind of really want to shy away from. There we go. Just fixing this. So what did I have to compare? I had to compare the bank, right? That was the only thing that really made sense. And there was many factors that was just so comparable. It is what it is, right? Okay. So with that being said, as I compare it to the banks, there's one thing that we found on the FDIC website that shared what was the banks doing. Okay. Well, jump to the punch. What is a flow? Okay. So what the banks are doing is that the banks have a specialized advanced structure life insurance product on all their type executives, on all their employees, and all their clients. That includes you, if you have a bank account. So these accounts are placed on you. You can look them up. They're called bank-owned life insurance programs, right? So it's life insurance, but here's the difference. The bank owns the life insurance program, and you are the insured. The policy is on you. The policy is on the employees. The policies are on the top CEOs. But the bank is the beneficiary. Hence, they're making money while you're living, and then they make money when you die. Okay? So if that's the case, right, and I saw that's what the banks were doing, then when I go turn over and I look at, my clients, well, what are they doing? They're doing the exact same thing. They're doing the exact same thing, right? And they have learned to leverage their cash value life insurance. So essentially what a flow is, a flow is simply understanding one behavior. And that one behavior is simply before you spend your money. No matter how your money came into your bank account, it can be by your salary. It can be a side hustle income. It can be business income. It can be from dividends. It can be from Social Security and annuity. It can be from your HELOC. It can be from a line of credit. It can be from credit cards. But whenever that money hits your account, you have to remember one behavior, and this is what a flow is. A flow is that you simply take those dollars that you're going to spend your expenses on, or that you're going to spend irregardless, and you take that money and you pay it into your life insurance program, and then you take a loan for it and put it back inside your bank account, and then you spend it. That's a flow. So a flow has 3 steps. It's super simple. Okay. Step 1, money is inside your bank account. Step 2, it goes inside your insurance policy. Step 3 goes back to your bank account. So you go ahead and take those dollars, spend it whatever you were going to already spend it on. Your utilities, your bills, daycare, school loans, car payments, salon, haircuts, shoes, whatever you were going to spend your money on anyways. Gasoline, whatever you're going to spend your money on anyways, go ahead, do it. But before you do, you got to do what, folks? You got to do what? You got to flow. You got to make sure that you're flowing that money through your insurance program. And then spend your money. So that essentially is a flow. Okay, that's essentially a flow. Now, the next question is, well, why flow money? I know you're probably thinking, like, hey, James, what's the point? Why flow money? Okay, so let's go ahead and talk about that. And how about I share my screen with you real quick? Let's talk about why do you flow money? So essentially, to flow the money, you got money inside your bank account. Okay. And that money is now is getting ready to go to your index universal life policy. If you don't know by now, we don't use term because term doesn't have a cash value. We don't use whole life because whole life is too expensive and the growth is very minimal, very nominal. But we use index universal life policies because they have unique features that will assist us to grow our money exponentially faster. So that essentially is a flow. That's a basic look of what a flow will look like. Okay. So this income right here, once again, that could be your salary. I don't know, some kind of cash flow, whatever that means for you. You got cash flow, dividends, annuities. Some of you guys have them. Okay. Social Security. Okay. Some people have credit cards. They utilize credit cards. I don't know, wherever you get your money from, however you are using it, you're able to flow that money. And you're simply putting it inside your bank account, from your bank account to your index universal life policy, back to your bank. And then you take that and you go pay, bills or let's just call them expenses. Right? That's a flow. But let's talk about why do we flow? What's the point of it? Why do we flow? So let's just break it down super simple this way, so that for those of you who already have your flow policies, you can just follow along and just really jump in and really start to understand the intricate portions of your flow and start to understand why would you flow? Why would you flow your money in and out your policy? All right, you ready? All right, here we go. So the first thing I want you to just go ahead and digest really quickly is that an insurance company must have 8 times as much money that's liquid and accessible. Call it the L and the A, liquid and accessible. That money has to be liquid and accessible. That right there is a global rule for insurance companies. So you have to have a minimum of 8 times as much money liquid than the policies that they are covering. Okay. Therefore, unlike a bank, right? Unlike the bank down the street, one of those big name banks, where banks only have to have a tenth of that money, insurance companies have to hold on to 8 times as much of that money and have it liquid and accessible. So because they can't touch that money, in the index universal life policies, there are 2 sides of the coin. There's the reserve side. Okay. And there's also the loan side. Let's talk about the reserve side, and then you're going to understand the loan side, and then you're really going to understand why we flow. So just bear with me. Here we go. Okay. So on the reserve side, okay, this is a fixed account. And this fixed account has a guarantee of a minimum of 4%. Guarantee a minimum of 4%. Somebody say guarantee. Guarantee, right? It's a minimum of 4%. Okay, it's a guarantee. And that guarantee has to, the money from your premiums, your premium dollars, minus your cost of insurance. That's your reserve account. Okay. So with that being said, let's say, for example, you got 100,000 inside of your reserve account of your life insurance program. Just stay with me here. I love this part. This part is about to be fun for me. Okay. Let's say you got 100,000. Well, there's 2 ways that you can pull that money out of your policy. Okay. The first way is by way of a withdrawal. There you go. You can take a withdrawal. So let's say you wanted to take a withdrawal of $80,000. Okay. So this 4% guarantee, 4% or more, that's guaranteed. So in your policy, that $100,000 is what's receiving the 4%. No matter what, it's receiving 4% interest. No matter what, it's written in your contract. It's guaranteed. Okay. But if you withdraw it, that means only 20,000 gets that guaranteed 4%. Are you with me? So if you take a withdrawal, you're decreasing the account value, and the account value that's inside your reserve account is actually what's getting the interest crediting. So the question is, does it seem like it's in your best interest to take a withdrawal? Now, I know many people do it. I know those infinite banking people, they normally talk about taking a loan from the policy. But the thing is, there's two issues with that. The first thing is that when you take a loan from a whole life policy, you got to pay that loan back before you can take another loan. Right? That's the only way it's going to work. And number two, you got to pay that loan back or your policy is going to lapse. So is that really the scenario that you want to be in, right? That, is there a better way? And if I could show you a better way, is that something you'll be interested in? Right? And many of you guys have resounded with an overwhelming yes. So instead of reducing the account value, many people say, you know what? I don't want to take a withdrawal. And then the insurance companies pops in and goes, well, guess what? If you don't want to take a withdrawal, there's another way you can do it. And the other way that you can take money out of your policy is by way of a loan. So what you're able to do is instead of taking a withdrawal, you take a loan of that $80,000, and that $80,000 never leaves your policy. It never leaves your account. It never leaves. However, you're able to take a loan and leverage your cash value as collateral within your life insurance program. And what will essentially happen is that your life insurance program or the life insurance company will then loan you their money. So you do not disturb interest. That is the whole point, so that you do not disturb interest. So on an average, the loan account generates 7%. It's the index, okay? Based upon the index, on average, it grows at 7%. Now that 7%, that's not my number. That's not our number. That's the number since 1926 through World War II, through 9/11, through the Great Depression. It has consistently averaged at a 7% return. So what happens? That 80,000 is then moved over into the loan account. It's index. That's huge. Okay. Now, because it's an insurance company's loan, the insurance company has a set of numbers of their own. It looks like this. So if the average 7%, okay, and then there's a fee for the loan at 3.5%. What does that leave you? 3.5%. But also built inside of your contract, people, was also built inside your contract with your flow account, something super amazing. It's called a credit, a loan credit. And this loan credit is equal to 2.5%. This is in the contract. This is not me saying this. This is in your contract, which means that $80,000 is now earning an average of 6% or more for every dollar that you're loaning out of your policy. There's a 6% credit or more that you receive out of your policy. So that's why we flow. That's why we flow, because the money that we're saving has a guarantee of 4%. I want you to think about all of you guys who have lazy money that's inside of your checking account. All that lazy money that's inside your checking account. Is it earning 4% or more? And if you say yes, I need you to put it in the chat box, because we need to know where we need to start banking at. Okay? If you're earning more than 7% or more, we need to know. We need you to put it inside the chat box, because we may want to go bank where you bank at. Okay? So this is essentially why we flow. This is why we do what we do. Okay? It's because we're going to make 6% compounded interest on average from all the money that we pull out and all the money that we leave in. We're going to make a guaranteed interest crediting of 4% or more. And that's written in the actual contract, your actual flow contract. That's what's written there. All right. So now just remember, as we're going through this, if you have questions, definitely put them inside the chat box. But as we're talking about flowing, why do we flow? This is the science of it all, right? People lie, but the numbers don't. The numbers don't lie. Okay. Now, what are some of the uses of a flow policy? What are some of the uses of a flow policy? That's another great question, right? Some of the uses for a flow policy, we have folks that understand if you have this policy, anywhere between 5 and 8 years, we can replace your expenses. Depending on how much in expenses you have, how much you're flowing, we can replace your expenses. 5 to 8 years. Okay. And other people are using these policies to replace income. That's normally an 8 to 10 year plan. That's normally, what a lot of people are thinking about that they're doing for retirement, to supplement their retirement dollars. And there are many people who are behind in their retirement planning. And this is the best go-to because you're literally able to start today planning your retirement. And being on this program, depending on how you flow, what's your flow number, what's your health status, right? A few other, things you got to take into consideration. You can seriously replace your income, whatever that may be, right? So some people say, hey, I just want to replace my expenses. That's, a paycheck, right? A paycheck, take care of my expenses. Some people want a paycheck and a paycheck, right? And that's the money that's going to cover what you're currently making now, your income or your desired income. Another reason why people have flow accounts is because this is one of the best ways to sell your business. You can literally take one of these policies, self-finance the sale of your business, and then through smart contracts, have whoever you're selling your business to at a reduced rate continue to flow money inside of your policy, and you'll make 4 to 10 times as much money over the course of time than you would if you just sold it the regular way. And by selling your business this way, there's no capital gains on the sale of your business. Aha, right? The other reason why people have flow policies and flow contracts is because they want to leave a legacy for their family. They want to leave a legacy for a nonprofit organization. They want to leave a legacy for a trust fund. Okay. I don't know where you're at in that, but that's the purpose. That's why we flow. That's why we flow. Okay. So what I would like to do now is just talk about really briefly the stages of a flow and what that looks like for everyone when you're considering flow and money. This is all educational. We're not here to sell, but many of you guys have a flow policy. So we want to make sure that you really understand what you have your hands on. Okay. So here we go. Let's switch the screen real quick. All right. So here you go. So you got 3 stages of your flow policy. And those 3 stages that you have inside your flow policy, excuse me, those 3 stages are very pivotal into everything that you're doing. So this is the life of a flower, right? All flowers understand this staging, and I want you to understand it as well. So these are the stages of a flow, of your flow policy. You got, the first stage is years. I can get this right. Wow. Come on, whiteboard. Don't fail me now. Don't fail me, whiteboard. Let me do it. I guess it wants to erase. There we go. Got the whiteboard back. All right, let's erase that right here. All right, so check this out, everybody. If you're going to flow money, you need to know that, years 1 through 7. That's stage 1, years 1 through 7. A lot of this can be expedited, but this is just the basic format. You got years 1 through 7, and through years 1 through 7, you want to save a 20 and have a 20% base. Okay, 20% base. So let's make that easy. Let's say you want to flow $5,000 a month, right? You're trying to flow $5,000 a month. Okay. 20% of $5,000 is $1,000. I sent somebody thinking it. 20% is $1,000. So what will happen is you will flow 5,000, but you'll leave 1,000. 20% base. What is your 20% base? What is your 20% base? Okay. That's what your flow number is all about, is understanding your 20% base. Okay. Well, that leads me to stage 2. Stage two is years 8 plus. Years 8 plus. Now, I stopped long enough to tell you that if you're going to get a flow account, it's the long game. It's thinking long term. It's thinking down the road, right? So let's just stop right here and say, hey, is this right for you? Well, here, let me ask you a question. Do you plan to live, 10 years or more? Everybody say yes, right? So if you plan to live 10 years or more, this policy is for you. That's why it kind of sickens me sometimes when people are only talking about having a term policy, right? Because if you got a 10, 20, or 30-year term, you're betting that you're going to die before 30 years. Because that's the only way you're going to get a benefit out of that term policy. It's more than just having, a peace of mind, as I hear it sometimes. No, you want to, make your money back. You want to get your money back or more, right? So it's for 8 years plus, okay? And at 8 years, you're able to take 100% of your money, no matter how much you can find, 100% of this money, no matter what, and put it in and out of your policy. So if you found, $500,000, you can put it in your policy and take 100% of it out. And you will get the interest crediting about average of 6% on that money. An average of 6% on $500,000. Let's make numbers easy. Let's take $100,000. Let's take $100,000. And I use this example for a lot of my real estate investors. I use $100,000 for a lot of my business owners. Excuse me. I use $100,000 for those people who have a bunch of lazy money. It's their emergency fund. They just don't really want to touch it. They don't want to get it locked up and put it anywhere. But let's say $100,000. You can literally take that $100,000, put it in your policy, and then take it out. Put it in your policy again, and then take it out. Like every month. For 12 months. That's $120,000. I'm sorry. That's $1.2 million that you put in and out of your policy. Why is that amazing? You remember that 6%? That's why we flow. That's why people are jumping onto this, right? And that's why you have a lot of high net worth individuals, NFL players, NBA players, high net worth attorneys, business owners, real estate investors. They're all flowing money. And it's just my job to teach you. Okay. So let's get to phase 3. Phase 3 is your distribution stage. The distribution stage, it all depends. The distribution stage could be, year 7, year 8, year 10, year 12. It all depends on your financial plans. What does that look like for you? Okay. Well, when you're doing this, you can simply consider, all of your options as it pertains to your flow. Okay. And many of the times as you're doing this, you want to think about what are your financial goals? Why would you want to, why do you want to flow money? What does that look like for you? If you were going to go flow money, sometime starting today, what would be your goals? Right. And then as you decide to meet your goals, then what we do is we assist you in helping you meet those goals. Okay. There we go. And so as we're helping you meet those goals, what I would like to do was just talk about how we help people shape and determine what those goals are as it pertains to having a flow account, right? So let's jump into this, okay? So let's say that you're trying to flow some money and you want to know why would you flow money inside your distribution stage. So we're talking about distribution, right? So there's 3 types of flows, okay? The first one is the savings flow. Okay. You want to replace your savings, grow your savings, but what are you saving for? Are you saving for retirement? Or are you, saving to pay off debts? Are you saving for, vacations down the road? Like you want to retire and you want to, go travel, 3 to 4 times a year. Okay, we can put that in the flow. Or do you want to save just because you need to save? That's it. You need to save. And many people say, okay, if I'm going to do this, how much should I save? What's the minimum amount to save? My opinion, you should try to average a savings of at least $400 a month. Where do I get those numbers from? Okay. If you watch me at any, for a period of time, I've always talked about, the breakdown at, 2002 and 2008, the dot-com bubble burst and the housing bubble burst inside 2008. And statistics say that people had to go into foreclosure. They were behind on the bills. They had all these overdraft payments just because they were lacking $287 a month. $287 a month. So when you do the numbers, if you start saving right now, $400 a month, God forbid any adversity happens, and you're watching your money, you're watching your expenses, watching how you're spending your money, $400 a month will be able to save you, will be able to literally save you. Okay. So continue doing what you're doing. But if you're interested in the savings flow, a minimum for the savings flow, I would just challenge you and say $400 a month. Number 2, the next type of flow that you have, which I think is pretty cool. It's called the expense flow, right? It is the expense flow. Now, the expense flow is special because it's basically flowing money into policy, and at some given point in time inside of the policy is just going to start paying your expenses. Whether you flow money or not, the policy is just going to start paying your expenses. That's what we want to build and structure for you. We show you how to do it. We put it in place for you. You want to replace your expenses. Okay. So what are your expenses? What are a few expenses that you can think of? Is it, utilities? Is it, let's think of another, your tithes and offerings, right? Transportation, gasoline, that's an expense, right? Gym memberships, that's an expense. Netflix, YouTube, some of you guys have expenses, whatever your expenses. If you're a business owner, your marketing, your advertising, your payroll, guess what expense everybody has? Taxes, shelter. What are your expenses? Are you keeping account of your expenses annually? And what's the rate at which your expenses are growing? Are they growing at a 3% or a 5%? So that's how we want to build your expense flow. We want to, at some given point in time, be able to tell you, be able to show you with all of these guarantees that are built inside of your flow account that your expenses will be replaced. That simple. Want to replace your expenses. Okay. Now, the third reason why we flow, we call it the max flow. And the max flow replaces income. The max flow replaces income. So let's say you are making $100,000 a year. And with that $100,000 a year, your expenses are roughly $40,000. And in your mind, it's not good enough for you to just be able to cover the expenses. You like where you're living at now. You like your income right now. You like your quality of life right now. So how I always strive the max flow is basically it's lifestyle insurance. You ever see like movie actors or maybe an NBA star, and well, let's just use movie actors. They don't do movies, all the time, maybe once a year. What happens if they take a sabbatical and don't do any movies? Let's take a teacher, right? Let's say, what about the teachers that maybe go on maternity leave or paternity leave? Well, if their expenses are paid, they're okay, they're fine, they're happy. But what if, I'm just saying, what if, whether you're a school teacher, whether you're a movie actor, whether you're an electrician, an engineer, you're running a business, what if all the money that you're making from your occupation, your business, or your investments will be guaranteed? That's the max flow. The max flow replaces your income so that you can do the things that you know that you will love to do. You get to wake up with purpose every single day. That's the purpose of the max flow. So we got 3 different kinds of flow. We got the savings flow, the expense flow, and then the max flow. Okay. And we break it down to its simplicity, to its most simplistic points, just so that we can make a very valid point here. Right. And that point is, hey, everybody needs this. Everybody can use this. Everybody should have one of these accounts, right? So if you're one of the people who are, watching the replay, mom and dad said, hey, hey, get on there and watch this and see if it makes sense. This is the reason why, because we're talking about how to replace, because we all need income. We all need money. It is what it is. That's why we wake up and go to work every single day. What if you didn't have to do that? What if you didn't need to do that? What if you wanted to do that? And that's where we're trying to get everybody. Now, I'm passionate about this. Research shows that when kids go to school, if a teacher is able to find their passion, like what they really like to do, what they're really good at doing, they tend to live a very fruitful life. They're very passionate about what they do. They're really good at what they do. They stay in whatever they're doing, whatever they're passionate about. They stay in that industry for years, and they become quote unquote gurus in those areas. How do you get there? Right? My recommendation is the max flow. So for all of you who are in the under 35 crowd, for all of you, if you're in the over 35 crowd, but mainly for those of you who are sick and tired of it and you just want to get on a savings regimen that has an end goal involved, this is what you want right here. Okay, this is totally what you want. So let me share my screen with you one more time, and let's just put a lot of this in context together. Okay, so you have a bank, and funds are coming into that bank. That's some kind of cash flow or income, however you want to put it, profits that's coming into your bank account. And when it goes inside your bank account, okay, it then leaves your bank account and it goes into your index universal life policy. And we've already talked about that 20% base, right? We're always going to make sure that we're saving in that 20% base. Now, the more you save in that, the 20% is the base. Can you do more than 20%? Can you do like 30%, 40%? I have a client and she's doing 50%. You don't have to, but it's there if you want to, right? You got a minimum amount that, that you leave inside your policy. And then from your policy goes back to your bank account. Let me show you how good this gets. Okay. Let's say you got investments. Say you got an investment account. That could be stocks, bonds. That can be your 401k, and we can show you how to flow all the money that's in your 401k. We can show you how to do that once a year. It's pretty cool. Okay. What about crypto? We have a client that's flowing their crypto dollars through their policy. That's pretty cool, right? Let's say you got real estate. You got all these different kinds of investments. How can you hedge against your losses of your investment? Take those funds, and you can flow it through your policy and then put it right back inside your investment account. And we show you how to do that in a tax-free way. And it's really awesome. So now you're constantly hedging against all of your losses by continuously flowing your money, right? Back to your bank account or back to your investment account, right? That's awesome. Okay. And then what about, I don't know, just saying, every single year, you got to pay taxes. So that money needs to come from somewhere. So before you go pay your taxes, you flow the money, right? Back to your bank account, and then you pay your taxes. And that's just for anybody who may want to take a little bit of money out of their investment accounts, right? Depending on your financial goals, you may or may not want to do that. Okay. So just trying to keep it lively here, just trying to keep everybody up on the positive and just get you to understand, why do we do what we do? Okay. So now let's leave that part right there. And then let's jump into some of what I call the nuts and bolts of this program, why people are loving it. And let's just talk about, first and foremost, is anything of what we're doing, is it taxable? Yes or no? Is what we're doing, is this ever a taxable event? Okay. And while I'm talking about that, Charles, thank you for asking that question there. You know, you said, what about owner operators and independent drivers? How would this strategy help? So as we drew that out, let's just use owners and operators as an example real quick, and let's just talk about it. Right, let's just break it down to its simplistic forms. And for those of you who may not know what an owner operator is, a owner operator, you've seen them before. They're truck drivers. Okay, let's just take this for example. Okay, so a truck driver is driving. Okay, they're driving on the highways and byways, and they're making money. Okay, and as they make that money, right, they got bills. I mean, they got expenses. And just basic trucking, right? You got your fuel costs. You have you got trailer fees, right? You have tolls. Okay. You got maintenance. Okay. I don't know. You got maintenance, oh yeah, food. They got to eat while they're on the road. Okay. And I can go on and on, but these are just basic expenses for an owner operator, a trucker, a business, anybody in transportation. These are your expenses. So what we recommend first and foremost is that we utilize your business credit. We show you how to do that, right? And for those of folks who are on our program, if you're using personal credit, we show you how to increase your credit score by 114 points. Or if you're a business owner, we show you how to increase your business credit score to anywhere between a 60 and 80. 100 is the highest. So we're doing pretty good there. Okay. So you utilize your credit to pay all your bills. And then when you get paid, you run that through your IUL. Okay. With your 20% base. You're always saving. Okay. And then back to your bank account, and you go pay your bills, you go pay your credit cards and all that good stuff off, rinse and repeat, right? That's how you help business owners. So we can take these expenses out right here. Maybe you're not an owner operator, maybe there's marketing that you use. Maybe there's, advertisement, salaries that you got to pay, right? Taxes that you got to pay. Whatever the deal may be, there's bills involved. There's expenses involved. And before you pay those expenses, all that we're saying is, hey, look, just flow that money before you do it. Just flow the money before you spend it. Okay. That's how we're helping those owner operators. That's how we're helping those business owners. And then what I really want to do is, as we're talking about all this, we also want to jump into really briefly is what's actually inside of a flow contract. What does it look like? What is it talking about? How can this be of service to you? And what's built inside your contract? Now, a lot of what I'm getting ready to tell you guys is going to be amazing. It's just probably, I know for me, some of these items, it just blew me away as I was checking it out. So first and foremost, who is a flow policy for? All right, if it's based in insurance, we definitely want to make sure that we take that into consideration. But so let's talk about it. Okay, there you go. So if you're between ages 18 and 85, you can flow money. Between ages 18 and 85, you can flow money. You got to start asking yourself right now, am I between age 18 and 85? All right, I think I can flow money. Okay. The next thing that I want you to know is that all this money that you're growing inside your policy is credited by whatever indices that you use. So there's a couple indices. And what do I mean by indices? There are ways of how the insurance company will invest money based upon your dollars. And however that indices is doing, that's how you're credited money. For example, the S&P 500. That's one that we like to start off a lot of people over the course of a year. What was the average? Once again, I said the average is about 7%. So S&P 500 is one. The Russell 2000 index is another. The MSCI EAFE index, that's another one. One that I like using as well is the B&P Paribas. Okay. Those is more of a global indices, right? So you want the top 500 companies inside the United States. Oh, let's see how the rest of the world is doing. You can do a B&P Paribas, right? The other thing that's built inside of your policy is that you get loan credits, right? As well as policy credits, right? So what am I saying? Whether the market makes money or not, you're going to make money. Why? Because it's in your contract. You're going to be credited money into your policy by just having your policy. Okay. Just hear me when I say that. What's one of the guarantees inside your policy? Okay. First of all, it's a death benefit. Okay. But also there's a guarantee of 4% built inside of your policy. Guaranteed 4%. Can it be more? Yes. Can it be less? Down to 2%. That's guaranteed inside your policy. Things got to be pretty bad for them to say it's only 2%. Even right now, of the current events that's going on right now, it's holding true, right? There's a minimum guarantee. Here's the other thing. There's a no lapse guarantee. There's a no lapse guarantee built inside of your policy. How many of you have been threatened that your policy may lapse? You got 30 or 60 days before your policy lapse. You don't have to worry about that here. Few other things, right? You have the capability of lifetime income inside your policy. You can add other people to your policy. Matter of fact, you can flow money through your entire family's policy. $1 would be that say $1 or $100 or $1,000 or $1 million can all be credited to everybody's policy that's inside your house. Now that's cool, right? Okay. The other one is disability benefits are built in. Wow. So we're talking about long-term care and disability. That's built into your policy. That's crazy, right? Over loan protection, meaning that your policy is still going to be active even if you loan out too much money. Oh man, that's good stuff. That's good stuff. All right. Okay. Just a few more. I probably can't get to all of them in this presentation right here, but it just blows my mind that there's an index floor, like 0%. Your policy will never go lower. Your policy would never lose money if the market goes lower. You only make money in this deal. All right. Warren Buffett rule number 1 is don't lose money. And rule number 2 is remember rule number 1. Right. And that's exactly what we're doing here. Let's see. There's a few more that I wanted to point out to you. Obviously, there's a 1035 exchange. I'm sorry, not 1035 exchange. If you currently have a policy right now and you want to convert it, you want to move it over, you want to make sure that you have these benefits. If your policy doesn't allow you to do some of the things that I've been talking about inside this presentation, guess what? It allows for you to do what they call a 1035 exchange. What about some of you who currently were misguided? Maybe you got a whole life policy, or maybe you got an index universal life policy, and it wasn't structured to be able to do what we're doing, to be able to flow money. Guess what? We can absorb your policy inside this policy right here. You see, why? For those of you who don't know, many people have a whole life policy or index universal life policies, and they've taken loans out of their policy, and now their policy is either going to lapse or it's not making money right now. They don't know what to do about the death benefit, and people are just like, they don't know what to do. This is what you do, right? You look at this as a possibility, as an option, and you see if it's a good fit for you, right? Okay. Let's talk about just two more things really briefly. Yes, you have a death benefit here. Yes, it's life insurance. Yes. There's a few things you got to care for life. They care for you for your life, meaning that no matter how many loans that you take out of your policy, no matter how much money inside your policy, no matter what your death benefit is, 10% is getting paid out for your death benefit. So if you got $1 million policy, you're guaranteed to get $100,000 for your family. Even if you had to make claims for long-term care or disability, no matter what, your beneficiaries still get $100,000 in that example. Okay. What about critical illness, cancer, stroke, heart attack? What about chronic illness? Right. If you come across those illnesses, and you remember COVID was a big thing, there was a lot of people making claims for their living benefits on their policy. And guess what? It's still paying out. I got a mom of twins that was diagnosed with a rare form of cancer that's getting a little over $17,000 a month. She said, James, I don't make this much money a month. I don't make this much money. I'm not used to this. What am I supposed to do with it? Flow it. Right? Just flow it. Okay. And a lot of times people say, well, James, how much does this cost? Okay. How much does it cost? It depends on how much you want to flow, how much you plan to flow. Right. We don't hide away from those expenses, because I'm going to tell you two things about the expenses that I'm getting ready to tell you about. Two things about the expenses that you should know. That's really amazing. That I love the way this is built. Okay. So there are premium expense charges, policy expense charges, as well as your cost of insurance, as well as a surrender charge. That's with any cash value life insurance policy that allows for you to take loans out of your policy. You want to know something really cool? After the second year, the interest in the policy alone pays for itself. So you have the interest that's growing inside of your policy, taking care of the expenses, taking care of the surrender charges. You have guaranteed growth inside your policy that's offsetting the cost of any loans all the way down to 1%. This is why we flow. That's why we do it. If you just listen to the numbers, just break it down in that way. Now, last thing, is it taxable? There's only two ways that a cash value life insurance policy can be taxable, right? Way number one, if you surrender your policy, means, you know what? I just want to cash out of this entire policy. I don't want it anymore. I want to take all my money. I don't know why anybody would do that with a flow policy, but just stay with me here. If you pulled all the money out of your policy, and the money that you pulled out your policy was more than the money that you put in, the overage of the amount that you put in is what you will be taxed on, is what you have the potential of being taxed on. Okay. Now, the other way that you can be taxed on your flow policy is if you put too much money in your policy. That's not my rule, it's the IRS's rule. If you put too much money inside of your policy, then you could be taxed on that overage. So what we do is we don't let you put too much money inside your policy, or we make sure that your policy is structured properly. All right. Let me get to my last point. My last point is, how do you even consider flowing money? What do you need to do first? What makes sense, right? Because we're talking about guarantees. We're talking about making roughly 6% back on all the money that you're spending. What does that look like for you? What do you need to do? Well, first and foremost, reach out to us on lasterfinancial.com. Go to The Laster Financial on Facebook, or meet us on All About Others on YouTube. And schedule to have your financial GPS activated. Now, your financial GPS gives you a bird's eye view of your whole financial situation, right? And asks you 6 crucial questions. And those 6 crucial questions is simply asking, hey, who's in your family or who's in your business? What's your salary? What's your income? What's your profits? What are you able to save? How much are your expenses? You know, how much credit card debt do you have? Do you have any loans? And then more importantly, what's your financial goals? If we can sit down and have that conversation, then your GPS is activated. You get control. You then start calculating your numbers. You then start budgeting. And then now you're ready to start flowing money. And when you think you're ready, when you think you're right to start flowing, then you complete your short sheet and directly send your application to be approved for a flow account directly through one of our portals or one of our channels. Goes directly to the insurance company. And upon your approval, our job is to help you open that account and then help you manage it. That's about it. Okay. So for those of you who are here and you were invited here by your friend, by a loved one, you know, you got a phone call, got a text, got an email, you know, folks at your job, you know, employer told you to be a part of this conversation. But there you go. Now you get it. You have the opportunity, just by doing one behavior, just like the banks, to flow your money into your policy and out. And the money that you leave in your policy, earn 4% or more on your savings and earn 6% or more as an average on all the money that you're spending. That's it. And that's why we say the more you flow, the more you grow. So with that being said, as we always say around here, though it may be hard, proper planning makes execution easier. Okay. I'm James Laster, Master Financial Planner, CEO of Laster Financial Consultants. I want to thank you on behalf of my firm, on behalf of my team, and all those who love you. Thank you for being a part of this presentation. Definitely check out the playback, rewind it if you need it, and definitely reach out to us if you have questions. Our jobs are to take the fear out of finances through education, and that's what we're doing here. Day in and day out, we're educating. So you guys take care, be well, be blessed, and until next time, be well.